Welcome back to my channel. So I want to show you guys the 10 most important terms, I'll say concepts you must know as a beginner in either ICT or SMC. Now, firstly is price action. Now, price action depends on how you analyze the market using your order block, your BOS, breaker block, change of character. For a beginner, to go further, you will know what they call breaker block and the rest. But for a beginner, you focus on your order block, fair value gap, change of character, your BOS. Those are the whole summary of price action. What is an order block? Now, an order block is scenario whereby markets it has rules whereby markets break structure. There is a break of structure here. Can you see that, right? And the last candle before the impulse move. This is the last candle before the impulse move. Not to get yourself confused. This is what we're going to mark as an order block. But as time goes on, when you keep practicing more and more, you will take this candle here as a form of order block. With time and time, when you keep practicing. Okay, let me look for another order block for you. You can see plenty of order blocks here. This is a bearish order blocks. These are examples of bearish order blocks here. This is a bearish order block because it's the last candle why before the impulse move. What do I see here? I see a bearish order block, which is the last candle before the impulse move. What do I see here? I see a bearish order block, which is the last candle before what? The impulse move, which created what? The break of structure. Can you see that? What are we looking for now? We're looking for what? A bearish in a bullish order block. Okay, let me find a bullish order block for you here. You can see one here. We have what here? We have a bullish order block here. You can see what happened here. There was a change of character here. And what happened? A bullish order block was created. As you go further in SMC and ICT, you will know the qualities you have to look for in getting a quality and a valid order block. Now, our third point is break of structure. Now, we all know that market does higher high, higher low. In the scenario, like for a bullish momentum, market does higher high, higher low, higher high, higher low, higher high. This for a bullish scenario. While for a bearish scenario, as you all know, market does this lower low, lower high, lower low, lower high, lower low. A bearish scenario has been created. Why? Because there was a break of structure in that sequence. Example, an example is here. You can see there was a what? A pull down here, and markets broke this swing high, which created what? A break of structure. You can see here higher high, higher low. And what happened? Markets broke this swing point here to create what? A break of structure. Let me go down the chart. You can see here what happened here. There was what? A break of structure. Market came down, created a lower low before the impulse moves were being done. Before the impulse moves, took out this high here, which created what? A break of structure. This is what we call BOS. Now, going back to the next term here, the next one is a change of character. What do you see here in the chart? You can see that market what? Let me delete this one. You can see that markets created a break of structure over here. Can you see it? There was a break of structure here. But what happened later on? The low was being broken. Higher high, higher low, higher high. This low was being broken. You can see it, right? This low was being broken. This is what we categorize as what? Our change of character. Do you understand? This is what we categorize as our change of character. Now, going back to the what? The fifth term, which is our fair value gap. Our fair value gap is also categorized as imbalance. It's like the healthy price action because we know that market always comes back there to fill those zones. In imbalances, you hear of healthy and unhealthy price action. We all know how unhealthy price action looks like. Those price action markets do not usually get to those zones. But when you see a healthy price action, let me show you one here. It always come in a three candle sequence. It does not matter the color of the candle. It doesn't matter the color of the candle as long as it's a three candle sequence. Example, this one we have one, two, three. I can put my line there. You can see there's a difference here. 1, 2, 3 is a three candle scenario. And what can you see? A reaction there. Why? Because there was order here that market had not come out to fill. Now if you look into this scenario here, you will see a lot of what do you call it, fair value gap. I have one here again, three candle sequence, 1, 2, 3. You put in your line here, and you also put in your line here, and you can see market actually reacted there in the future. Do you see? As a point of interest, can you see that, right? So this is how you know a valid fair value gap is a three candle sequence. You can count this one, 1, 2, 3, and mark here as your fair value gap. Can you see that this is a fair value gap? And also this is a fair value gap. It's a three candle sequence, 1, 2, 3. You can mark from here, this upper high to here, also as your own fair value gap. So I hope this video, okay, let's keep continue. I hope this video is impactful, and I hope you're gaining some value. So we have equal lows and equal highs. How do we know equal lows and equal highs? Let me look for a range for you. This is an equal low. You can see this is an equal low. Market retested those zones twice. 1, 2. There was a retesting there twice, which market took out in form of liquidity. And you can look up here. There was also an equal high here, which market took out also as liquidity. So there was a range here. It went here, hit here again, came up, hit here again, came up, hit up here. Some people call it double top or double bottom, but this is what we call equal highs and equal lows, where market reacts in a particular like point, hit a particular point several times. Some people do have different type of trend lines here, but this is what we call equal highs and equal low. Now our premium and our discount using your Fibonacci. How do you know your premium and discount? A structure must take place first. A structure must take place first. Example, there is a break of structure here. Using my Fibonacci, I'm going to start from the low. I'm going to start from the low to the high. Now the up here, the up, that's the 50% up to the up here, from the low to the high. 50% upwards is our premium, while 50% below is our discount. In a scenario whereby there's a slogan that calls you buy low, sell high, buy low. So if you are here and market is buying, you don't want to sell, you don't want to buy high. You want to wait for markets to come down low before you take any trade or anything in this setup. So now you're going to buy low to sell high. If it's a sell scenario, you're going to sell high to buy low. What do we have the next? Divergence. I know many of you have heard of what we call DXY. Now, DXY and majority of the time EUR/USD, they move in a sequence. In the scenario whereby if DXY is selling, EU will be buying. If EU is buying, GXY will be selling. Example, let's assume on EU, market is going higher, high, higher, low, higher, high, higher, low, higher, high. In DXY, market will be doing this. Can you see that? So this difference of the divergence, DXY is what many traders actually use as a confluence, mostly for the dollar strength, to know the dollar strength to other currency and the strength of dollar to other currency. Judas swing slash liquidity grab. It's the same thing that happened here, Judas swing. You can see it right here. It's like a range. A range took place inside here. Can you see that? There was a range in here and market took out liquidity. Can you see that before it started going on in direction? They can also call it a what do you call it? Liquidity grab. Majority of people use Asian lows, those Asian range that happened during the Asian section. A lot of traders use those trades, those Asian range to actually trade it. So it's a range whereby markets any can break up, it can break down. When markets break those zones, you just wait for a change of character to take place in that scenario and continue in its direction. Point of interest depends on you, whether you mark your fair value gap or your other block, and you're waiting for market to come to that direction and going to react. You call that those areas your point of interest for markets to react in those areas. So I hope this video was impactful to you. Don't forget to subscribe on my channel, take note of these terms, do your personal research to learn more about it, and I hope you're enjoying the YouTube channel courses. Thank you.